welcome everybody, and thank you for joining our mini masterclass Thursday, whether or not you're here live with us or during the replay. And from wherever you're finding us, we really appreciate you hopping in. And today's topic, we're joined by DeAnn Chase, who is a business attorney. I'm going to let you have your own intro, but we're going to be talking about what it looks like if you want to sell your business. And DeAnn, you did a DeAnn at her desk about this a couple weeks ago, and I loved it so much. I was like, that's what I want to talk about, because you had so many good things in just that tiny little snippet to share. And I wanted to, of course, dive deeper into what that looks like. But part of what you said and mentioned was good records, good financial records. So of
So
course
important.
that
So important. I've had
yeah, so that
deals die over poor financial records.
Yep, I've seen them too. I've not ever sold my business enough to see it on my side, but I've seen it through other businesses, or I've gotten clients because they're trying to sell their business and their books were a mess and they're like, "Can you please help me fix this because I'm going to lose this deal if it doesn't get fixed."
Yeah, that's not
These
usually the best time to be calling someone, right? You
no,
would
because
prefer that they call you much, much earlier, and I would prefer that too.
yes, and then what kind of confidence does that leave the buyer if all of a sudden you're scrambling to get good books, right? And then do your books match your tax returns? Are your tax returns even done? Are you several years behind? There's all of that. But before we get into it, I would love for you to introduce yourself and your practice.
Great. Well, I'm DeAnn Chase, as you said, founder of Chase Law Group. We have a law firm in Southern California that works with business owners and professional practice owners, and we help them with all of their legal structures. So we are the go-to law firm for anything relating to your business. So we help with everything from, proper formation and maintenance of entity structures, contracts, trademarks, protecting your intellectual property, which is also important when you're selling your business. Independent contractor versus employee issues, commercial leases. So basically all those issues that we work on with our clients. And I'm just glad to be here. And it does seem like lately I've been talking with clients, even just today, I had a couple of like we offer corporate packages for our clients and we follow up with our clients on an annual basis. So every year at a minimum, I'm talking to my clients and I have 3 clients this time of year, every year, the same 3, it's like their annual review time. And they're all like preparing for a succession plan. So literally over the past couple of days, this particular topic is very close, near and dear. And literally this morning, I had a client send me, their letter of intent for me to review the letter of intent for their business sale.
Oh, great. Oh,
Yeah.
wow. So you're also making sure that what they're walking into is solid.
Right. Yeah, definitely. I mean, from a timing perspective, when you're selling your business, one of the questions is, when do I bring in a lawyer? Right? At what point in time do I bring in a lawyer? And if you get to the point where you're listing your business with a business broker, then a lot of times, unfortunately, the brokers are like, here, we have these forms or these templates for you to use. So, just go ahead and sign these. And then they go, oh, yeah, you should talk to a lawyer, but they really don't mean
Right.
it. And in fact, this letter of intent that came in is on a form prepared by the California Association of Business Brokers. And I'm not a big fan of some of these forms. Some are better than others, but every deal is customized. So what I tell my clients is, when you're hiring your broker, have me review that contract so you know what you're getting yourself into with regard to exclusivity and when you have to pay the broker a commission for the sale of your business versus if you happen to be at a cocktail party, talking to Joe and Joe's like, oh, I'll buy your business. Now you have to pay your broker a commission, right? So,
Oh,
so that's one issue. And then, like I always tell my client, when the letter of intent, and I usually recommend, by the way, that you sign a letter of, you have letters of intent, as opposed to, I recently had a client come to me, their broker was using some form that said asset purchase. And I was like, and she signed it saying, oh, but it's just part of the negotiation. I'm like, it says asset purchase. So technically, that
Mhm.
is the agreement subject to counter amendments. It was a big mess, especially big mess, especially since she was a physical therapist and we had talked about, like, she was one of those ones we had been talking to for years, for the last several years, about selling your practice and that sort of thing. And we talked about how important it was for her to do a stock sale versus an asset sale. So when she came to me with an asset purchase agreement already signed, I'm like,
Oh no.
this is a big problem. And that's not your letter of intent. So the letter of intent is an opportunity and a place to set forth the material terms for the deal. And a letter of intent will always say, it's non-binding, except for maybe some certain terms like confidentiality, exclusivity, different things like that. It's non-binding, but it's really an opportunity for both sides to negotiate the material terms of the sale, so that then
Hmm.
by the time you spend the time and money of having a lawyer, legal
Hmm.
fees and due diligence costs,
Yep.
kind of in putting the agreement together and that sort of thing, at least you know that the material terms have been uh, in place. So,
Yeah.
uh, yeah, just definitely so many things to talk about.
Yeah. And before I move on, I need to say it out loud that I'm squirrel braining because I saw the word Scotland on your wall, and I'm super jealous that you were in Scotland in July.
Oh, did you see that? I was in
Anyway,
I was in Canada in June and Scotland in July.
July. Well, I'm still jealous, but congratulations on that.
Thanks.
So yes, and I also want to bring up, I too have seen, I'm not a lawyer, so I don't do them, but I too have seen when people come to me because they're in a want to sell, and then they're like, oh, can you just put this here and just put that there? Or I just said I I sold this much, so can you make my books say that I
Say
sold that much?
what I said. Yeah,
Say
right.
what I told him, and I'm like, absolutely not. We can clean up the numbers and we can show you what it really is, but we will not ever make something up. What is the due diligence? Because you mentioned due diligence behind what a buyer is going to want to see. So people understand it's not just the bookkeeper or the accountant going want, want, want. It really matters if you want a successful sale and successful succession. Say that times five times fast. And then to build on that, about what does it cost someone to engage you or a lawyer and actually go through this process? Kind of a two-part question.
Yeah. So
Yeah, sorry.
that's a lot right there.
Yeah, sorry. We
Sometimes
can go
there's no
backwards.
such thing. Sometimes it's a simple question. Um,
Right.
let's start with the due diligence process, right? So the idea being is certainly before you start having conversations with a potential buyer of your business, or if you're selling, you're selling the business or on the buying side, usually if you're on the sales side, you want to make sure you have a non-disclosure agreement signed first, right?
Okay.
And the non-disclosure agreement, I always draft in the non-disclosure agreement what's called non-circumvention as well. So non-disclosure is you're not, somebody's going to be opening up their books, right? And that's what you're asking. But before you open your books, open the kimono, as you will, then you want to make sure that they've signed off that not only will they not disclose the information that you provide, to a third party, but that they won't use it, and they won't use it to circumvent you to get through to like your customers, your clients, that sort of thing. So,
Oh, right.
so that's something for us to be aware of. Like I have people come to me and say, "Can I use ChatGPT for my NDA?" It's like, well, yes, but you still want it's a starting point, but you still want to have a lawyer review it. So that's something that maybe a standard NDA wouldn't necessarily include, would be the non-circumvention part. But so that's included. So then you get to the point where, okay, sometimes there's some due diligence before the letter of intent is exchanged, because the buyer's like, well, I want to know what the basic numbers are, right? So, and a lot of times it depends too on how the business was valued, whether it's based on EBITDA or seller's discretionary earnings or different ways that, or I had a client who said, I don't care what anybody values it. I don't want to like leave my business without $500,000 on the table. So it's kind of like, well,
Hmm.
the valuation is whatever the hell the seller wants, right?
Yep.
And
Yep.
so then at that point in time, though, and this is where you with the on the financial side probably are better off to say what's asked for, but it's at least what 3 years, tax returns minimum,
Mhm.
P&Ls, balance sheets, different things like that. But I mean, what do you see? What are they looking for when they're looking at those financial numbers?
Typically, what we've been asked to produce is the P&L and the balance sheet, but also, what I do is I take it a step further and I also ask for the tax returns so I can determine, do your tax returns match your books?
Right.
Because so many times people go to the tax preparer does not do their due diligence, so they're just putting numbers in a system, but they're not confirming the accuracy. And then they don't update the books with the end of the year journal entries and things to make sure you tie it out and the equities match and things like that. So I catch that first because I know that's the next step in what they're going to see. They're going to see that the tax return doesn't match the financials. That's going to lead to questions and doubt and, back and forth. And all of this stuff costs money because it's somebody's time to review their questions. It's your time. It's my time
Mm,
potentially to answer the questions of what's in the financials. Maybe even going back to the former taxpayer and say, can you give me notes on this? Because a lot of them haven't done the notes either. So
right.
that's what we try to do also, but it's typically the P&L and the balance sheet, and then making sure it actually matches
Right.
or is done right. I typically get clients in this. It's not one of our client. One of my clients that's I've had long term has never had this scenario. But what's happened is people have come to me because they don't have the information they need for
Right.
the buyer. And then I'm in there cleaning it up, trying to reconcile it, making sure that it's accurate. Why is there $30,000 negative on your credit card? Oh, because I never put any of the expenses. I just had the payments going to the credit card and nobody caught it. There's all kinds of stuff we see.
Yeah.
But yes, the P&L and the balance sheet. And if they're not accurate, you got nothing because your tax return is only as good as the information you gave your tax preparer. So if you don't
Mm,
have clean books to have gotten the number to give your tax preparer,
right.
that tax return is no good
Yeah.
whatsoever.
I know.
Yeah.
I know. It's true. And then too, like some of the things that you just said too are very important. Going back to the entities, the legal entity structures,
Not sure.
right? And making sure that your entity is the right entity to begin with to allow for a successful sale. Well, that you have an entity at all, I should say.
Mhm.
Sometimes if I have someone who's a sole proprietor now who wants to sell their business, their financials and there is all commingled being a term of
Yep.
art with their personal finances
They're
and bank
personal.
accounts and different things like that. So, I mean, first and foremost,
Yeah.
when you're going to sell your business, you definitely want to have, an LLC, limited liability company, or a corporation, and then people in this and topic for another day, right, is corporate compliance and maintenance of those corporate minutes and all of that. But the important thing though, when the valuation is being done and looking at the corporate, um, you mentioned the credit cards, for example, you need to make sure that you've not commingled, if you have a corporation or an LLC, that you don't have personal expenses, right, on
Hmm.
the credit card statements or commingled into the bank accounts, because number one, that's a liability function, right? Somebody can pierce the corporate veil if you've commingled. But beyond that too, when a buyer is looking at, the value of your business, or even if you have a broker valuing your business, well, they do what are called add backs. They add back in some of the expenses to determine what the value is. And if you've put,
Yep.
maybe some car expenses or, some office supply, different things like that, that get kind of added in, and you just need to be sure that you're not commingling your personal and your business accounts. And then when you're going to then sell, right, one of the things they're going to be looking for is they want to know, for example, that your records are clear. Oh my gosh, I see it way too often. Now that I'm thinking about it, oh, what a mess. When somebody goes to sell their business, for example, and they have all these, particularly in small corporations, but LLCs too, but definitely in corporations, we see this a lot, where the stock certificates are not consistent, right, with who the owners are. And you might have a random person who at some point in time owns stock, and now your client is telling you, oh, they don't own the stock anymore, and maybe the tax return doesn't list them. But if at some point in time this person did own stock, and then have you properly documented that they're no longer a shareholder, right, in your corporation,
Mm-hmm.
right? So even a small corporation has to keep corporate records, corporate minutes, and really important to document who the shareholders are. And in an LLC, the equivalent of a shareholder is a member, right? So who are the
Yep.
members in the LLC? And then that's when you really want to have a solid operating agreement, which is the governing document in your LLC, as far as, it should have a schedule that says who the members are, what percentages they own, what their capital contributions have been, a lot of different things. So,
Yeah. But that all goes back down to the financials. The financials should have all of this represented. And if they don't, then there is cleanup to do and there is things that aren't correct. So when you hand it over to the
yeah.
buyer, they're not looking at accurate information.
Right. And while you're saying that as well, is the owners of the business, the corporation or the LLC, need to really document when money goes in and money comes out. Like, what is it? Right? Because I've
Mm,
had it before where a client goes to sell, and the CPA will just put in the tax return shareholder loans, right?
right.
There's
Yep.
no promissory note or anything like that. And it's like, well, if money is going in, and someone, I talked to a client today, and she's like, well, how do I get the money into, the corporate? How do I put money into the corporation? And she has a partner. So I'm like, well, you guys need to have a partnership agreement known as a shareholders agreement in corporation, or buy sell, or something that says when money goes in, what is it? Is it capital? Because capital just goes in and whoosh gets washed back out. Or is it a
Yep.
loan with the expectation of repayment? Because if it's a loan
Payment.
with the expectation
Hmm.
of repayment, then you should have a note, and that needs to be documented, and it needs to be documented in the tax returns and all that. So
So what if you're a S corporation of one because you just took the S corp election? Do you need to write yourself a promissory note just to be documented for compliance and due diligence purposes?
I mean, as a lawyer, I like more paper than less.
Right. That's
So,
why I'm asking you.
I do think it's important because, again, when you go to sell your business, have you documented that you're complying with the formalities? But
Yep.
at a minimum, if I don't have, yeah, so it's nice to have a written note. But in a single shareholder corporation, not necessarily, but it still needs to be documented in the tax returns. Like,
Got
that's
it.
where, and even money coming in and coming out. So sometimes, out of a convenience, maybe someone will use a personal credit card for something. I don't advise it.
Yep.
But if they do,
Right.
for whatever reason,
We don't
maybe they get
either.
miles or what have you, then as long as they're documenting it and the tax return is a distribution,
Distribution. Yep.
right, and it's being accounted for, then it's not commingling. I mean, it's commingling, but you need to document that it isn't.
Properly. And we educate on that as well. If you're going to use your business account for personal, it has to be documented as a draw, an owner's draw, a member's draw, or a distribution, period. It can't be on there as a business expense. And you just brought up something. I'm thinking, we have an S corp compliance package that's based on the financial side. So it's the reasonable compensation analysis, it's some tax planning, it's the accountable plan that you need to have in place if you're going to reimburse yourself for expenses that you're paying for the business. But you're talking about compliance that's a whole nother side of compliance, which is the minutes and the agreements and the operating agreement and all of that. Can you touch on, if you have an entity that doesn't have any of that in place, can you still sell it? Will anybody buy it? Do you see that people are buying and selling corporations that are mess as far as compliance goes?
They're harder to sell because
Mm,
they have to get cleaned up at some point in time.
okay.
And like you said, it causes more questions. So
Yeah.
yes, you can sell one that's messed up, but you're not going to get the full value for it.
The top dollar. Right. Got it. Yeah. And, and when you sell your business, you can still be audited from the times that you had your business
Hmm.
and you were the owner, because those were your tax years.
Right.
And when and if the IRS or your state agency determines that you were not compliant during those periods, you can still be fined and penalized after you sell your business because it was from the time that you owned it, right?
Well, yeah, it's funny because you have that corporate veil of protection,
Mhm.
except when it's the IRS, right? The government gives and takes.
Yes.
So it's true to say, though, that once you sell the assets of your business, for example, and then you dissolve your entity, when
Hmm.
we help someone to dissolve their entity, we document what assets, if any, they take when they dissolve. Because if a lawsuit comes in later, then then that entity continues to provide that liability protection for the time that the business was in operation. Because keep in mind, the statute of limitations lawsuit could come in 2, 3, 4 years down the road. The entity may
Right.
not still be in existence, but to the extent a creditor would be successful in their claims, they would not be entitled, assuming the corporation or LLC is properly maintained and documented with minutes, etc. They would not be permitted to access the personal assets of the individual owners, but they would be permitted to access any assets that were distributed, assuming that the distribution was allegedly wrongful or what have you. So, usually there's $5 in the bank account when we dissolve it. We prepare corporate minutes. It says, $5 was in the bank account and distributed to the shareholders. So if that lawsuit comes in later, then
Yeah.
it's $5.
Yeah. Awesome. I love that because I think people have a misconception that once I sell my business, I'm off the hook, which is not necessarily true if you get audited in tax years that you were the owner, and then there's corporate compliance on top of that. That
Well, and
should
that's a
be.
problem too. Like, keep in mind, and again, this is the difference between an asset sale and a stock sale.
Mhm.
And so an asset sale, and I've been on both, I help businesses on both sides of the transaction, right? So if I'm on the buying side, then the buyer wants an asset purchase where there's like, hopefully they're buying, some assets out of a shell, like a corporation or an LLC. So it's like, you pick, I'll take that, I'll take that, I'll take that, but I'm not taking your liabilities.
Yep.
Right. So I'm not going to take anytime you've breached contracts or misclassified independent contractors as employees or, employees as independent contractors or what have you.
Yep.
So an
Yep.
asset purchase is most ideal on the buying side because those liabilities do continue to run with that corporate entity. In
Yep.
some circumstances, the stock sale is where you actually buy the entity itself, as opposed to picking the
Mm.
assets out. And then in that
Mhm.
case, there are some, like for some sellers, particularly sellers who've had their corporations a long time, the stock
Mhm.
sale can be better from a tax perspective. And sometimes if I have professional practice owners who have like insurance contracts tied to the entity, or you've got different contracts tied to the entity, then we'll sell the stock, but the buyer in doing that really assumes the liabilities of the entity up to that point. And of course, in the purchase agreements, we provide for indemnification, right? We say in the event, I get sued for something that happened while you were operating the business, you agree to defend, indemnify, and hold me harmless. But in the corporate entity, it's a little more difficult to enforce that.
Yeah, this is so good. So you said something earlier that about ChatGPT, and I just want to ask, is if somebody has some sort of contract, NDA, something that was drafted from AI or LegalZoom.com or something like that, is that actually legally binding if they don't engage a real attorney to move forward in the process?
Yeah. It's if both parties sign it, that is a legally binding document. And
Binding.
that's why I say, particularly if you are, and I'm in California and there's a rule of interpretation that says if you give someone your contract to sign and they sign it, and there's an ambiguity in the contract, meaning a reasonable person could read it one of two ways, it's construed against you. So, like, you need to know what your contract says, particularly if you're going to be handing that contract to someone, because if two people sign it, that is a legally binding document. And if there, and a lot of times, sometimes, you don't, some people don't even realize what's in the boilerplate of the template, in the
Right.
legally, right?
Yep,
It's
yep,
like
yep, yep.
a lot of people sometimes don't read that or know what it says, and then it can really come back to bite them. And I just got off the phone with a client. We are talking about AI, right,
Mm-hmm.
in the web space, and AI bots being used for interviews with potential customers and different things like that. But AI hallucinates, right? So if
Yeah.
it doesn't
Mm-hmm.
have an answer, it's going to give you an answer and it's going to create it. It's going to make it up.
Yeah.
So,
Right.
so yeah, these contracts, regardless of what they say and whether they include everything and whether they're legally correct or not, if two parties sign it, then now the four corners of that document are your contract. And that's a whole other topic is, if you have
Yeah.
conversations before you sign the contract, people are like, well, we talked about it, but it's not in the contract. Well, guess what? It doesn't exist anymore
Doesn't
because there's a
exist.
clause in the boilerplate that's called the integration clause that says this is now the entire agreement of the parties. And
Yep.
anything you said before or was told at the same time, unless it's fraud, which is sometimes your only way out, you're bound by whatever's in the four corners. So if the document's put together by AI, that is your contract.
That's, they said, you always hear, did you get that in writing? Did you get that in writing? Because your verbal contracts, your agreements, your handshakes aren't legally binding. I actually have,
That's not exactly true.
no?
They're binding. People are like, oh, I don't have a written contract. I don't have a contract. Oh no, yes, you do. It's called a verbal
Oh,
contract. You
yes.
have an agreement. The problem is enforcing it.
Okay. Okay. Yes.
Sorry, I had to
Okay.
correct you. I had to jump in there.
No.
It is
Okay. You're
legally,
right.
yeah.
You're right.
You
Yes.
can have a
So,
verbal promise, to pay someone in exchange for their performance of, an activity or what have you. That's a contract, even if it's not in writing.
okay.
But the problem then becomes he said, she said, he said, she said, I sent an email, I confirmed it, they agreed to part of it, but not the other part of it. Then they said this, but then that got taken back. So then what is the agreement, right? And then when you go to enforce it in court, which I did litigation for 10 years representing businesses in court, if you put it, if it's in writing or parts of it in writing, now it's time consuming and expensive to prove. Now your contract is this series of email communications and text messages.
Okay. Okay. Well, thank you for correcting me because it's better to have right information than wrong information. Definitely. Our family actually has a very bad experience with this topic because my grandpa, who just trusted the person who was potentially buying our family ranch, 100 acres in Wrightwood, gave him a contract. He didn't read it. He signed it. It's binding. Both parties signed it, like you're saying. He sold the ranch for $1 and
Wow.
it it was legally binding. I mean, this was years and years ago and I was a kid, so I don't have all the details, but I know that you can sign something and then you're just screwed if you signed the wrong thing. If you don't really know what you signed or didn't have the proper
Right.
documentation or like you're saying, it has to be right. And so I know we're at time and I so appreciate you coming on.
There's so much
Any
to talk about. I know.
I know we could do this for hours. Any kind of if you could give one tip to somebody who wants to sell or someone who's buying businesses, maybe that's how they're doing scale by acquisition. What's a good tip of rule of thumb that you want to leave?
Oh man.
I know, put me on the spot.
I'd say here I put me in a spot. The one tip. So no, I mean the one tip would be to go through that letter of intent process, right?
Yes. Okay.
Instead of like just either just like jumping in. Some people are like, oh, we'll just put the agreement together. I'd say definitely you want to have well, first you want to have a non-disclosure agreement signed with the non-circumvention included in the non-disclosure before you provide documents. Then you want to have that letter of intent in place to make sure your material terms are agreed upon before you open the kimono and then let somebody into your, because if they're not serious, sometimes your competitors will try to get you in a conversation. They're not really serious about buying your business. So if they've got, you've got a signed letter of intent, even if it's
Mhm.
not entirely, it's non-binding, if they're engaging attorneys to get their letters of intent in place and different things, it shows that they're serious about it. So I'd say
Yeah.
definitely my tip would be take the time and pay the money for a
Yeah.
lawyer to be involved
Right.
in the transaction from the start.
Yep. Every single person, I'm going to say, every single one I've ever talked to that didn't pay the lawyer regretted it because something dramatic has happened. Some drama has happened. Something bad took place at one point in the process, right? Thank
Yeah.
you, DeAnn. We really appreciate you. And where can people reach you?
Yeah. So Chase Law Group is my law firm, DeAnn Chase. I'm on LinkedIn, on Instagram, and I'm located in Manhattan Beach, California. So DeAnn Chase at Chase Law Group.
Thank you. And we will be back actually next week. We're not doing 2 weeks apart this time. We'll be back next week with our 10-year anniversary episode, where we are going to sit with our whole team and just talk about PBS from day one to day now and the future. So it'll be a fun little happy birthday celebration that we're doing next week.
Great. Well,
We appreciate
congratulations on 10 years. That's a big one.
you. I know it's crazy. I never thought I would be able to say I've been doing this. I've had this company 10 years, so it's really cool.
Yeah.
But thank you for your time, and you're awesome. And we will see you on another episode. And actually, DeAnn and I have 2 other, I believe, mini masterclasses on our YouTube channel that are for employee contractor. The conversation about that and the importance of that. And I believe there was one other one we did, but I can't remember the
We did
topic.
do another one.
Anyway, they're on our
You know what I
YouTube
think? Was
channel.
it proper business entities, maybe?
Yeah, maybe entity
Maybe
selection. That
legal
probably
essentials
sounds
for a
right.
proper business entity.
Yes.
All right.
Anyway, you can find them on YouTube, and we'll send out the recordings to everybody who signed up. Thank you so much.
Bye.
Bye.